Hey everyone, Amazon stock keeps making record highs and is on a phenomenal run since bottoming out in 2023. I can understand investors feeling like they missed out on Amazon stock, like it's too late to buy. Now, I don't agree with that. I still think Amazon stock is a buy. In fact, I have Amazon stock rated still as one of my top stocks to buy. But understandably, if you don't want to chase a flying stock, if you want to wait and prefer a better entry point and prefer to buy companies when they're lower rather than when they're on this high level increase, that's understandable. So if you feel like you missed out on Amazon stock, I've got one in this video that you could buy instead.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
And that stock I'll be talking about in this video is Sea Limited. You can see here Sea Limited share price is down to $56.37 per share after it was trading at over $300 per share. You can see that dramatic decline in the stock price. So investors feeling like they missed out on Amazon, on feeling uncomfortable buying Amazon here at all-time highs, and you want to get something that's lower, and the saying goes, buy low and sell high, Sea Limited is an excellent choice here, and I'll go over why I think that's the case. Starting with the company's excellent revenue growth over the last decade, you can see its trailing 12-month revenue is up to 13.06 billion. That's up from roughly 200 million in 2017. The stock's revenue has absolutely exploded as the company's online offering has continued expanding. Now, it'll not likely reach the scale of Amazon at 600 billion in revenue, but it doesn't need to reach that scale to deliver investors a solid return on investment. Not only has it increased its revenue, Sea Limited has also boosted its profitability. Its operating profit margin is up to 2.26%, jumping higher from the negative 125% in 2018. So as it's grown its revenue, it's used that revenue growth to boost profitability, demonstrating economies in scale, which means that revenue is increasing more than costs are increasing, which is creating a gap between revenue and expenses, which leaves for greater profitability on the bottom line. Now, on top of profitability on the bottom line, the company is generating strong cash flow, near record highs, in fact. 2 billion in cash flow from operations over a trailing 12-month period in the most recent update. That's bounced back strongly from the negative 1.5 billion it reached in mid 2022. And this big drawdown in its cash flow from operations is a big reason why the stock price collapsed from where it was in 2021. No, one of the reasons. There were other reasons, including some restrictions about its online gaming platforms and such, but for the most part, all of those factors led to a declining cash flow from operations, which typically leads to a declining stock price in most cases. Now, looking ahead, the analysts on Wall Street that are following Sea Limited stock, they expect it to deliver 128% earnings per share growth each year over the next 5 years. Now, while that might be an overly optimistic forecast from Wall Street analysts, even if the company approaches anywhere near those levels, that's going to be great news for stock investors, for Sea Limited stock investors. Even if it grows at 100% below where Wall Street expects, it's still going to deliver phenomenal returns for investors, even if the growth rate for the next 5 years is only 28.3%. Because I'll share with you towards the end of the video, the valuation is acting as if this is a very slow growing company, a company that's not going to be growing earnings per share all that much over the next few years. That's what the valuation suggests. And so you're getting a company with phenomenal EPS forecasts and estimates, and you're getting it at a relatively cheap valuation. And I'll share that with you at the end of the video. So the balance sheet of Sea Limited is solid. It's not great, but it's solid. It's got 5.35 billion in cash and short-term investments, 7 billion in long-term assets, and if we add long-term debt to this equation, you could see that the company is doing relatively well in terms of the balance sheet, 3.36 billion in long-term debt. It's got more cash at 5.35 billion than it does in long-term debt at 3.36 million. So its cash to long-term debt position is swell, and its total long-term asset to total long-term debt position is also relatively strong. So it's not in any danger in terms of the balance sheet. And then on top of that, when you consider that it generated over 2 billion in cash flow from operations, the balance sheet is okay. It's not in any difficulty. In fact, it has excess money available in case it finds growth opportunities to invest, or in case it wants to buy back shares, or it could choose to pay back some of that debt. It has flexibility. Management has choice because of its strong cash flow position coupled with the balance sheet. It has options, it has choice. It can use that to its advantage. And finally, it's trading at the cheapest valuation going back a couple of years. C Limited is trading at a forward price to earnings of just 20, which you can see here is arguably the cheapest it's been. Around January, it was a little bit cheaper than where it is today, but going all the way back to January of 2022, it's very close to or at its cheapest it's traded for. So if you were looking at Amazon and thinking like, oh my God, I don't want to buy a stock at record highs, I should have gotten Amazon earlier, it's too late now, what else can I do? Well, C Limited is a solid choice. You can see Amazon stock price jumped and then fell, and now it jumped again. C Limited stock price jumped and then fell. Could it be on the cusp of another jump? I don't know. I don't tend to pay much attention to technical analysis. I tend to focus more on those other factors I discussed more in this video: the revenue, the profit, the cash flow, the expectations going forward, and the valuation. And those factors suggest to me that the stock is undervalued. And when a stock is undervalued, the stock price tends to move higher to reflect a more equal valuation, a valuation at equilibrium, instead of leaving a stock undervalued. Stocks don't remain undervalued for very, very long. Sometimes these stocks that appear to be undervalued may be value traps, in that their value never recovers because these factors don't improve. The operating profit margin, for instance, we saw that it increased to 2.62% and is on an upward trend line, right? We saw it improving and getting better and better and better. And so let's say, for instance, we make this investment in C Limited, and going forward over the next 24 months, the company doesn't improve its operating profit margin. It flatlines. So this upward trend was the end of it, and then it flatlined. Well, if that happens, then it's likely that the stock price wouldn't increase, because a company operating at a 2% operating profit margin deserves a cheap valuation. And so it'll continue to trade cheaply because its operating profit margin is 2%. That's not very attractive. However, if this trend line continues and it keeps expanding this profit margin, then the valuation is also likely to follow along and become higher, because companies that are improving their operating profit margin higher and higher and higher as revenue grows, they command better valuations at higher profit margins. So there is the risk that C Limited could be a value trap, but in my opinion, I feel that it's undervalued and it makes an excellent investment, especially for investors feeling like they missed out on Amazon stock. Again, let me remind you, I still think Amazon stock is a good value even at these higher valuations. But if you want something else, then C Limited is also a good choice. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.